that we're onto something, that innovation is going to disrupt every sector out there, and they want to be on the right side of change. We have educated them. We have a 5-year investment time horizon. Everything we do, keep your eye on the prize, average down if you can, and usually that sort of disciplined behavior will work out over time. We often say time, not timing. In fact, one of our clients in Japan, Mizuho Fuke-san, that's his words. Those are his words. Time, not timing. And we have a chart now. If you held stocks instead of trading around them over time, you would have done much better than trying to time. So that's the retail base. So they're holders and they're averaging in. Institutions, in 2020 we had incredible performance. Innovation solves problems. COVID brought with it a lot of problems. And I think a lot of institutions looked at us like, what is this in terms of where does it fit into my matrix? And so we don't fit neatly into a matrix that any of these ratings agencies have or so forth. So I think we're being put into the alternative bucket. We're the closest to a venture capital fund in the public equity markets. And now they're looking carefully at us because of our research. The screen for our portfolios is not any benchmark. In fact, until recently, I didn't know what was in benchmarks. And I didn't know that of the 28% in technology in the S&P 500, we don't own any of them. We're very different. We're not backwards looking, we're forwards looking. And I think institutions are beginning to see the bifurcation between valuations in the private markets when it comes to innovation, which is where they are, and innovation in the public markets, and they're saying there's an arbitrage opportunity.
And what are you thinking about ARK's underperformance, and how do you explain that to investors who might be worried about
Well, the investor who has been attracted to our strategies is a younger investor. I'll say it's across the spectrum, but the younger investors and the older investors who take us seriously about our 5-year investment time horizon, they're fine, because if you look at the past 5 years, we have outperformed NASDAQ, S&P, while I don't know what the number is, 75 to 80% of truly active managers have not. So we have that as a calling card, and we have a 5-year investment time horizon. We also give away our research. This is why we're investing in this space. And now we're playing more of a ground game, I would say. We're going to be publishing more of our models. So Tesla, we will put that update on GitHub next Monday, and we'll be tweeting, and our analysts will be doing videos so that our investors can understand the depth of knowledge that our analysts have, beyond the depth of knowledge, I think, of any other analyst in these technologies. The reason for that is we have organized our research teams by technology. There are 5 major platforms involving 14 technologies that are cutting across sectors. So they're technology specialists and they are sector generalists. We think that's the right way to think about innovation. And I think that our investor base is reading our research, seeing the merit that it has, and they also understand how these innovation platforms are going to disrupt the investments in their base portfolios. The thing is, when we saw the yield curve invert, and if you look at the 30-year to 2-year, it's a waterfall. It has come back a bit, steepened a little bit, partly because short rates have come down, which suggests to me that there are some people out there who might agree with us, who are saying, okay, the Fed, what's priced into the market right now is another 7 or 8 interest rate increases. That's priced in. And now they're saying we're going to be more aggressive than that. We'll go 50 basis points at a clip. We're going to get aggressive in terms of quantitative tightening, no longer quantitative easing. And so we're looking at consumer sentiment down at levels we have not seen since 08-09. Think about that. Record-breaking employment reports, record-breaking, unbelievably good. And yet the consumer is feeling terrible. 08, and no one's talking about this. Everyone who's saying, the economy's strong, no one's talking about a consumer sentiment. This is the University of Michigan Consumer Sentiment, suggesting that the consumer, which is 2/3 of our economy, is not happy and is actually depressed. because their wage gains, income gains, are not keeping up with inflation. Their real income is dropping, and I think that the Fed has to watch out, because we see auto sales coming back down, and everyone says, "Oh, that's supply chain." We see furniture stores, big disappointments. Restoration Hardware is a good example. One retail industry after another is saying, "Whoa, something's happening here." But the headlines out there from a macro point of view are not picking up those micro signals, nor are they picking up the consumer sentiment surveys. So we're just looking at the facts, and we're looking at all of the data. And the final piece I'll add is, if you look at the inventory buildup that is taking place right now, partly because consumer demand is disappointing expectations, inventories can build up very quickly when the consumer goes on strike. So inventory to sales ratios might be low right now, but they can go up very quickly when the consumer says no mas.